On 24th March 2025, a group called the Payments Council of India or the PCI wrote directly to Prime Minister Narendra Modi. Now, the PCI represents over 180 digital payment companies, which includes names like PhonePe, Google Pay, Razorpay, BharatPay, and also Cred. Now, in their letter, they brought back an old demand that keeps coming back here and there. They basically want to remove what is called the Zero Merchant Discount Rate or MDR policy for UPI and RuPay debit cards. Now, I know this might sound a little bit technical, but I'll tell you how it works and why exactly it matters to you in this very episode. Welcome to the Daily Brief Show by Zerodha, where our aim is to cut through the noise and simplify the biggest news and stories in the financial markets in a way that is easy for all of us to understand, yet one level deeper as compared to your traditional news channels. I am your host Anurag Bansal, and today is Thursday, the 27th of March. And in today's episode, I'll talk about two interesting stories. In the first story of the day, like I said, I'll talk about how UPI providers want to now be able to charge for UPI payments and the fact that they've written directly to the Prime Minister's office regarding it. And in the second story, I'll talk about what's exactly happening with the Indian Rupee after having a steep fall against the US dollar just some time ago. Let's get on with the first story then. See, like I was saying, on 24th March 2025, a group called the Payments Council of India or PCI wrote directly to Prime Minister Narendra Modi wanting to remove what is called the Zero Merchant Discount Rate or MDR policy for UPI and RuPay debit cards. Now, I know this sounds technical, but here is how it works. See, whenever you make a digital payment, whether it is by scanning a QR code or by using a mobile app or even swiping a RuPay debit card for that matter, there is a big and sophisticated system that is making it all possible. It basically connects your bank account to the seller's bank account and manages everything between it. Now, it needs servers, cybersecurity, innovation, and constant upkeep in order to ensure that payments go through instantly and safely. And of course, all of this costs a lot of money. And in order to cover these very expenses, banks and payment companies usually charge what is called the merchant discount rate. Now, merchants pay this fee because they benefit from receiving payments digitally. Because after all, more and more customers now prefer to pay using their phones or their RuPay credit cards. Sometimes these fees might get passed on to customers or they might be split in different ways. But in most parts of the world, an MDR is a normal part of the digital payment system. But in India, it is a little bit different right now. We have something called the Zero MDR for UPI and RuPay debit cards. And this means that no one pays that very fee. Now, this policy officially kicked in around January 2020 when Finance Minister Nirmala Sitharaman first announced it. Now, for your context, it was not always zero. Initially, when the NPCI, which is the National Payments Corporation of India, launched the UPI in 2016, there was a small MDR in place. The government started by subsidizing some of these fees on behalf of merchants, but eventually they decided to scrap them altogether for UPI and RuPay debit cards. Now, the idea behind Zero MDR was very simple. By making digital transactions completely free for merchants, even a small shop in a remote corner of the country could now afford to accept money digitally. The government basically wanted to push digital payments so that India's economy could be more transparent and less reliant on traditional and old kind of cash. And from the government's perspective, that goal became true in a very, very big way. UPI quickly became the most popular digital payment method, at least in many large cities. You can see its success every time you walk into a shop where there is almost always a QR code and you can just scan it with an app and pay instantly. But the thing is, Zero MDR has its own very consequences. See, although it is great for merchants and it also boosts digital adoption, the companies that make the entire system run in the back end, which is banks, payment service providers, and other such entities, are now left without a direct way to earn back all of that investment. Now, building and operating such massive infrastructure, obviously, as you understand, is not at all free. Someone obviously has to pay for servers, cybersecurity, and round-the-clock maintenance, and also new features for that matter. So if merchants pay nothing, then the money has to come from somewhere else. Currently speaking, the government does offer incentives to soften the blow for these companies. Over the years, it has allocated budgets to encourage certain categories of UPI UPI transactions. And these sums have grown from around 1,389 crore rupees in 1 year to 2,210 crore rupees the next, and then 3,631 crore rupees, and more recently 1,500 crore rupees specifically for small transactions up to 2,000 rupees. But that said, the industry says that these amounts are nowhere even close to what it costs to keep everything running. One estimate from industry stakeholders suggests that it costs around 10,000 crore rupees every single year to maintain and even expand the UPI infrastructure, although we don't know exactly how they arrived at that figure, to be very honest with you. Now back to the PCI, they are now arguing that zero MDR might not be sustainable for very long. They are worried that if payment providers cannot bring in enough revenue, they will either stop investing in new technology or they will start making money in less direct and sometimes even murkier ways. Instead of having a clear small fee for every transaction, companies might actually start to introduce hidden charges, start to sell user data, or even bombard people with advertisements, or even say bundled products to make up for the shortfall. Now, none of this is ideal for a healthy, transparent payments ecosystem, as you might have figured by now. Now, in its recent letter to the Prime Minister of India, the PCI talks about how 90% of India's merchants have relatively small annual turnovers of under 20 lakh rupees. Now, these tiny shops, street vendors, and local traders would be the hardest hit if an MDR suddenly popped up. Now, the PCI suggests that these smaller merchants could continue to be exempt, but for larger merchants like the bigger stores or businesses with turnovers of over 20 lakh rupees, the PCI proposes bringing in a modest MDR of about 0.3%. Now, that is much lesser than what you see with credit cards, which is at roughly 2%, or prepaid instruments at about 1.5%. Now, in theory, if the bigger players do pay this fee, it could definitely help cover some of the infrastructure cost without really putting pressure on the smaller shops that the government wants to bring into the digital fold. And of course, if the government does agree to reintroduce an MDR for larger merchants, we still have to consider what that means for customers like you and I. Do shops pass on the cost to us by raising prices or adding convenience charges? Or will that make people go back to using cash instead of digital payments? Or maybe could it slow down the enormous progress that we have made in financial inclusion, where even rural areas now have a track record of digital transactions that helps them access loans and other formal financial products? But on the other hand, if the fee is small and it only affects big businesses, maybe it will not really be such a big burden. Now over here, it is important to note that some merchants already charge extra for certain transactions, calling them service or convenience fees. Now these might not be official MDR figures, but they still show up for an end user like you and I. So if a clear and modest MDR system were to be introduced, it would make the system a lot more straightforward instead of leaving people confused about random extra charges. So in the end, it sort of boils down to whether or not we can keep UPI or RuPay transactions free forever. They have basically become the backbone of digital payments across our country, and they help many new merchants join the formal financial system. But building and maintaining these digital rails costs a lot of money, and businesses need some way to recoup that expense for obvious reasons. And that is why this question of reintroducing an MDR, even if it is just for a certain category of merchants, keeps cropping up now and then and catches everyone's attention. With that, let's move on to the second story of the day. See, the Indian rupee has recently taken a bit of an unexpected turn in the currency markets. For your quick context, not too long ago, the exchange rate for the rupee against the US dollar was hovering around 87.4 rupees, which suggested the rupee was losing some amount of strength. Then, almost out of the blue, it started gaining ground and moved below 86 rupees. Now, mind you, in the world of currency trading, this is a fairly big swing. So to understand why exactly this matters, you can think about what happens when a country's currency strengthens or maybe weakens. See, if the rupee becomes stronger, then buying foreign goods becomes cheaper for obvious reasons. An imported phone or holiday abroad can cost you less money in comparison. But at the very same time, goods that India exports starts to become more expensive for people in other countries, which can hurt exporters. But if the rupee weakens, the exact opposite happens. Imports get expensive, but exports look more affordable to foreign buyers. And this is why a very sudden move in the currency markets affects different parts of the economy differently, and also why economists start to pay close attention to these very shifts. Now, see, until very recently, most people were thinking that the rupee would keep getting weaker as time progressed. Our economy's growth had been disappointing, inflation felt a little bit sticky, and our country's trade deficit seemed to be getting bigger and bigger. Foreign investors did not seem too excited about putting new money into Indian markets, and the RBI, which is the Reserve Bank of India, had decided to let the rupee move more or less by itself rather than stepping it to buy or sell dollars to keep the currency within a certain price range. Even an investment bank called MUFG that had been analyzing all of this data concluded that the rupee was likely to remain on the weaker side. But then March arrived and everything sort of changed. According to MUFG, part of the reason of the rupee's surprising bounce has to do with developments elsewhere in the world. Now, one very key development involved the euro, which started to gain strength because Germany decided to spend more on its economy, causing the US dollar to weaken slightly. And the moment the dollar became less dominant, emerging market currencies like the rupee often get a chance to rise in comparison. But that said, the rupee did not just keep pace with its peers. It actually outperformed many other Asian currencies, which basically signals that there is something else that is unique to India that was also happening. See, MUFG's report highlights the change in India's trade situation as well. India's services exports remained strong while imports of certain items like gold and oil went down. And that improvement in India's trade picture meant that the difference between what India sells abroad and what it buys from abroad started to shrink. In fact, when goods and services are added together, India recorded a rare surplus in the month of February. And on top of that, our country's inflation readings for the month of February turned out to be less severe than what everybody had expected. This lower inflation number made investors think that the Reserve Bank of India might lower interest rates in the coming months, which can attract certain kinds of investments into India's bond markets. Towards the end of March, there was also a small but meaningful inflow of more than $1 billion due to the way global equity indices were rebalanced, which brought short-term support to the Indian rupee. But even with all of these positive surprises, MUFG remains cautious about where the rupee will go next. Instead of predicting a steady decline, the bank is now neutral, but that does not really mean it is optimistic either. It has changed its forecast and it now expects the rupee to end the year at around 87.5 rupees against the US dollar, which is slightly stronger than its earlier prediction of 88.5 rupees, but still weaker than the levels we are seeing right now. There are three main risks that MUFG points out in its analysis. The first risk involves potential tariffs from the United States. Basically, if American trade policy starts to take a more protectionist turn, India could be in crosshairs of sorts. India is not as dependent on exports as some other Asian countries are, but the US is still one of the biggest trading partners that we have. Exports to the US directly account to about 2% of India's GDP, and some estimates say that the figure could be closer to 4% if you account for the total value that is added by different stages of production. And higher tariffs on Indian goods can dent that part of our economy. The second risk is India's growth outlook. See, people often hope for India to clock annual growth rates of 7 to 8%, but MUFG expects growth to be around 6 to 6.5% now. This is not exactly weak, of course, but it is slower than what many investors would like to see as such. Some analysts suspect that part of the growth early in 2023 may have been temporarily boosted by one-off factors and that the underlying economy still faces hurdles such as tighter rules on lending and reduced public spending on infrastructure projects. The third risk relates to the RBI itself. See, recently the RBI has not been very active in the currency market, allowing the rupee to find its own path, so to speak. But that said, the MUFG says that there is a good chance that soon the RBI may want to rebuild its foreign reserves. And on top of that, the central bank is sitting on a net short position of $77 billion in what are called forward contracts. So if it decides to unwind or to manage that position, it will need to buy dollars, which all else being equal would push up the USD INR rate and weaken the Indian rupee. But that said, in the middle of all of these risks that I just spoke about, there are also multiple reasons for hope. The Indian government has announced income tax cuts that could encourage more domestic spending. MUFG predicts that the RBI will cut interest rates 3 times this year, which may help reduce borrowing costs and spur the economy. Inflation, which can sometimes force the central bank to keep rates higher, appears to be softening a bit as well, and there have not been yet any dramatic spikes in food prices. So if the RBI can keep inflation under control, it can afford to keep lowering interest rates and add more liquidity into our entire financial system. So in theory, this should help the economy run a lot more smoothly. And if you look at the longer run, India is trying to diversify its trade partnerships by engaging in talks with the European Union, the United Kingdom, and New Zealand, among many other countries. There is also the possibility of a deeper trade agreement with the US before this year ends, which would reduce the chance of sudden tariff hikes as well. Now, all of these efforts are basically meant to make Indian exports less vulnerable to changes in a single major trading partner's policies. But until then, the rupee's recent rally looks like a result of a rare combination of factors: a weaker dollar, fewer imports, steady services exports, and lower than expected inflation. That brings us to the end of the two stories of the day. With that, let's move on to the final section and talk about the quick news headlines. First, JSW Steel has become the world's most valuable steelmaker with a market capitalization of 30.31 billion US dollars, overtaking Nucor Corporation at $29.4 billion and ArcelorMittal at $27.14 billion according to Bloomberg data. Despite reporting lower trailing 12-month revenues of $21.1 billion compared to ArcelorMittal's $62.4 billion, JSW Steel commands a higher PE ratio of 28.5 times versus ArcelorMittal's 20.3 times. Second, Tata Electronics has approached the Gujarat government for an additional 80 acres of land in order to expand its semiconductor fabrication facility in Dholera. The new land will support housing and infrastructure, including around 3,000 studio apartments for workers, along with a shopping complex, sports arena, and entertainment facilities. Third and the final one, Samsung and 7 of its Indian executives have been ordered to pay a total of 601 million US dollars by Indian authorities for allegedly evading import duties on telecom equipment supplied to Reliance Jio. The demand includes 4,460 crore rupees in unpaid taxes and penalties, along with an additional 81 million US dollars in fines levied on top executives, including the network division's vice president and CFO. That's all the news and stories I have for you today. I hope you enjoyed the episode. This is your host Anurag Bansal signing off. Take care and I'll see you tomorrow. Bye-bye. Disclaimer: this content is for informational purposes only. None of the stocks, brands, or products mentioned are recommendations or endorsements.